I'm James Turk. It's my pleasure to be here today with John Embry, the Chief Investment Strategist of Sprott Asset Management in Toronto, Canada. John, we're here in the island of Jersey, in the Channel Islands. We were here a year ago. A lot's happened over the past year, but I wanted to ask you, when we were sitting here a year ago, gold was $14.90. Today, gold is $15.90. Silver is a few bucks lower than it was a year ago. Why all the panic in the market?
Well, I think it's the volatility that's being created, much of which appears extremely counterintuitive. I mean, the gold price peaked back at the end of August, $1,900, give or take. And this was in the wake of the U.S. Downgrade. And subsequent, like the attack on gold, and even more so on silver, just didn't make a whole lot of sense. You could say it might have been overbought a bit because it had gone up sharply. But for it to be down like $350 over the next 3 or 4 months, to me just seemed like overkill. And then it was recovering nicely in February. And then we had what they called the leap day slaughter. And it was $17.80 at that point. And suddenly they drove it down as low as $15.25. And in the wake of terrible news coming out of Europe, and just a generally very positive backdrop in a normal circumstance for gold, and yet the price acted terribly. And I mean, I can give you a number of reasons why, and it had nothing to do with sort of logical selling. There was a lot of forced, selling.
Yeah. And
this created some natural selling, but just most recently, I noticed that when the gold price was getting really slammed around in the last couple of weeks, open interest was going up. So this wasn't sort of specs being driven from the market. There was lots of fresh shorting. Mm. And to me, the situation got horribly oversold. And we've started to rally the last couple of days. And I mean, we could sort of test the bottom again. But as I like to say, if you're negative on gold, you must be bullish on currency. And I don't see how anybody can make that argument. So consequently, we may have a few, $50, $100 in downside in gold under probably worse circumstance. You're probably talking thousands of dollars on the upside. So the risk reward is so positive that I'm not sure why people are upset, but they are. The sentiment is about as negative as it gets.
Yeah, well, I think there's been a lot of negative news. The media attention that's been given to gold has been sort of negative, and that makes people worry, makes them a little bit scared. And plus, I suppose as well, to a certain extent, the New Year's, the leap year day slaughter, sort of counterintuitive because the ECB creates, 500 million euros out of thin air and the gold price goes down. So, that I suppose gets people worried to a certain extent.
Well, that to me was so blatantly obvious, the LTRO of, as you say, 500 million euros. And within hours.
500 billion, I should say.
Yeah.
I said million, but
500 billion.
500 billion.
But within hours after that, Bernanke comes out and says some arcane statement about there was no QE planned in the near term. And this was the cover they used to slam the gold price down. Mm. I mean, the mainstream press has clearly been very negative. But I mean, if you actually analyze what they're saying, they're not saying anything. Perhaps one of the worst things I saw was one of the noted pundits on the subject said, because gold has been down so much in this environment, it's clearly not a safe haven. Well, that's why it is down, because they don't want it to be seen as a safe haven.
Yeah. But the point is that it's always a safe haven because it's a tangible asset. And it doesn't have counterparty risk, which is increasingly important as the banking system here in Europe is falling apart. And the banking systems pretty much everywhere are very, very fragile.
It's absolutely true what you just said, James. What I find perhaps most irritating is this expression, risk on, risk off. And so somehow they've gotten the gold lumped in with what are viewed as the risky assets, stocks, commodities, what have you. And that when there are problems afoot, like things are deteriorating alarmingly in Europe, they basically sell down all the risk-on assets, and they include gold, and they try to sell you the idea that basically the risk-off asset is the US dollar and US treasuries. And I mean, if you really stop and think about that very long, I mean, those in the fullness of time are going to be about some of the riskiest assets in the world. And anybody fleeing to them for safety, I think, is making a terrible mistake. What little you gain in the short run, I mean, it's a trade conceivably, but somebody's got to own all this stuff before this is over. And I mean, who wants to own U.S. Treasuries when you see what's going on with the deficit and where the interest rate levels are and what future inflation is almost fated to be?
Yeah, they're no longer really a piece of paper that you can buy to generate yield. At best, they're a trading vehicle, but there are a lot of other better things for trading if you want to trade. But my point has always been that, you know, for the vast bulk of people, they shouldn't be trading. They should be accumulating gold, because that's the way you're going to preserve and enhance your wealth in a major bull market, which is what we actually have going. You know, the fact that gold is still up from where it was a year ago, notwithstanding this correction from 1900 down to 1600 or just under 1600.
Well, this is a very powerful bull market. I mean, I can think of virtually nothing that has sort of been up 11 years in a row. And as of this moment, it is actually up from the year end, although with the way the sentiment is, you'd think gold was down about 20%. I think part of that's being generated by the terrible performance of gold shares, which to me are even more counterintuitively negative than the gold price weakness recently. I will go on record as saying that if the gold price does what I believe is inevitable, and that is surge back to new highs in the not too distant future, the magnitude of the increase in the gold shares is going to shock people. Like, I managed a dedicated gold share fund for 15 years. And there were at least 3 or 4 periods in that time when my fund was up over 100% in less than 12 months. And I think that at no time in the past was there a better buying opportunity in the shares than there is now. So I am very optimistic about what can happen there. And given the level of pessimism amongst the investors towards gold shares right now, it further encourages me to the opportunity.
Yeah, you know, the shares began a bear market back in 1997 when Embry collapsed.
I remember it well.
Yeah, and there were a lot of things along the way that negatively affected sentiment. You know, the disastrous hedging programs by some of the miners. You know, people are saying, you know, why should I buy shares if they're just going to, you know, sell forward revenue and leave their expenses unhedged and ultimately get into trouble. Then, you know, the ETFs made it easier for people to buy paper gold instead of paper shares, and you know, it just sort of continued. And the margins were squeezed because input costs back then were rising much faster than the gold price, so they weren't making any money. But you know, the last few years, the share prices have been clobbered. But if you look at the cash flows and the PEs of these mining companies, they're doing very, very well, which is, again, very counterintuitive, isn't it?
Well, I think there has been interference in the market, and that has engendered short selling by hedge funds, and that has then engendered further selling from dedicated gold funds who are getting redeemed. And then your natural buyer, like a lot of the retail clientele that like to play in this field, they've been really badly hurt, and they've been fleeing the sector. Yeah. So it's been sort of just a cavalcade of negative developments from a technical sense. And they've created just a fantastic opportunity, which I think will be unleashed by a dramatic rise in the gold price. And I believe that's inevitable.
Yeah. Do you have any thoughts? You know, here we are in May, you know, what you're looking for toward the end of the year on gold and silver?
Well, I've been sort of fairly consistent. I've said certainly through the old highs, and sort of 2,000 is a nice round number. And I mean, but it wouldn't surprise me if it were better than that, because I think once this thing gets ahead of steam, or there's a greater loss of confidence in currencies, I mean, it won't take much migration of money out of paper into gold to have an enormous impact. And I think before the bull market is over, we're going to see a massive stampede out of paper assets into gold.
Yeah, you're talking about paper currencies.
Paper currencies.
But what about people stampeding out of paper gold into physical gold?
Well, that's a subject that is particularly offensive to me. Like, I think that people have been really misled in the paper gold field. And I really do believe these estimates that for every $100 of paper gold, there may be $1 of actual physical gold backing it. And it's all being replicated with derivatives and all sorts of paper machinations. And there will become a day when enough people realize that when they really need their gold, they don't have gold. They've got these paper replications of gold, and that will be something that will have an enormously positive impact. And you can't really predict when that will happen. I mean, but when an idea's time has come, it's amazing what transpires.
Yeah. You know, a year ago we were talking and looking, toward the future, and you were of the view that hyperinflation is still in the cards, which is something that I believe because of all of the government debt that's being monetized by central banks around the world, which is typically the way you lead to hyperinflation. Has there been any change in your view that that's potentially the way we're going?
None. I think very simply, James, that to me, there's no middle ground left. What we're faced with in the world is either a disastrous deflationary collapse immediately, if they do not provide sufficient liquidity to deal with all these various things that are unfolding in the financial and in the banking scene. And I don't think anybody that's in power today wants to see voluntarily the system collapse on their watch. So the easiest thing to do is, they say, kick the can down the road and print as much money as is required to sort of keep things lubricated and afloat. And this thing sort of has a life of its own. You keep doing that long enough, and then suddenly the velocity of money, which has been actually declining, picks up as people suddenly realize they don't want to hold this money anymore because they realize that it's losing value quite rapidly.
Yeah.
And that's when it really starts to accelerate. That hasn't happened yet. But I think that it's inevitable if we continue down this road. And I'm a great believer in Jim Sinclair's statement, QE to infinity. And I love that statement because I think it's exactly what's going to happen. And the end game in that is some form of hyperinflation.
Yeah, from a central bank and government perspective, I guess that's the line of least resistance?
It is. I think one of the reasons Ben Bernanke's in as Fed chairman is he expressed that very cogently at one point in the past when he said, you can always avert deflation by printing money because we've got printing presses, and if worst case, we can drop money from helicopters. I suspect that was one of the qualifications is why he became the head of the Fed.
Well, he is a world champion printer, but I'm wondering whether Mario Draghi is going to claim the title given what the ECB is doing. Do you have any thoughts on the euro?
Yeah, I do. And I've never been a great fan of the euro. And I always thought at some point under difficult economic conditions, problems would arise. But I must say that the problems that have arisen have even exceeded my most perverse thought. And I don't see a way out in the sense that the maintenance of the euro as we know it today in the European community. I think that some of these peripheral countries are going to have to go. And that basically is going to create some chaos in the system. And that chaos can only be controlled by more money printing.
Mm-hmm. But, the money printing, we're talking about kicking the can down the road. And a couple of months ago, I was being interviewed on King World News, and I said to Eric King that the can is now a 210 boulder, but they're still kicking it. But do you have any sense as to when they can no longer kick it any further? Are we close because of what's happening in Europe? That's
the big question. I think that the European situation is well known, and people have focused on it. I think a catalyst may turn up in some place you're not looking. I think the U.S. situation is worse than acknowledged because I do not believe there's any vitality in the U.S. economy. If you're running $1.5 trillion budget deficits and you have a zero-based interest rate policy, and you can barely get the economy to move ahead at all, and your employment situation is not improving in the least, mm-hmm. I think this is a problem that's only going to get worse. And then but that's maybe too obvious too. I think one that may catch people by surprise, I am not bullish at all in the prospects for China in the near term. I think that this idea that they can just turn a lever and the economy is going to pick up again is wrong. And I don't pay any attention to the GDP numbers they announce, whatever. I watch what they consume. And if you see when there's cement consumption, their electricity consumption, it's going down. And that to me is more of an indicator of sort of where their economy's headed. And I think something going on that front will force them to print a great deal of money. And it's going to be kind of like a global Weimar will start to unfold. And at some point, that's going to catch the market's attention. Yeah, if Keynesianism doesn't work in Europe, it's not going to work in China or the United States at this stage when all of the governments are over-leveraged. And the Chinese government is over-leveraged as much as all of the others. Of course it is. And their banking system, if you look closely at it, it's no better than some of the banking systems in Europe.
In some respects, it's even worse because it's been more politicized. A lot of Chinese government state-owned industries, have received, instead of subsidies from the government, soft loans from the Chinese banks.
No question.
And there's a lot of doubtful loans, on the books of the banking system, which actually brings up a point that is a little bit chilling in the sense that, there are problems all over the place. We're talking about a global problem, not just an isolated problem in Europe or one country or this country. It really is a global problem, isn't it?
It is a global problem. And I would add, although I think the probability is highly in favor of sort of some hyperinflationary end, if they make a mistake and they sort of try to practice a little too much austerity, or they're not forthcoming quick enough with liquidity, they could trigger a deflationary event, and those are hard to turn around once they get underway. Mm-hmm. But gold is a great asset in either periods of strong deflation or mounting inflation. So that doesn't disqualify gold as the asset you want to hold. Where you don't want to own gold is like the period we had in the United States between 1980 and 2000, where we had the disinflation era, where financial assets did fantastic and they were basically too much competition for gold.
Yeah.
That is not the case today. I mean, I find it when people say, well, sell gold, my response is, well, what am I going to buy? I don't like the stock market. The bond market is, in my opinion, the bubble in the world. It's grossly overpriced.
Yeah. And
the ones that aren't, the ones that are bearing high interest rates, they're going to default. So to me, gold just stands out like a sore thumb. And silver. When I use the word gold, I mean silver, which may have more upside because of its high beta in relation to gold in a rising market.
Right.
But to me, precious metals, particularly after the price takedown that we've seen over the last 8.5 months, are a fantastic opportunity. And this is what people should be exulting over, the opportunity to buy this stuff so cheap at a time when the fundamentals for it are improving daily.
Yeah, what I've been recommending, consistently now since I've started Gold Money, over 10 years ago, is that you just every month or every other month or every quarter, just accumulate, put buying gold into your household budget, because when you're buying gold, what you're basically doing is you're saving sound money, and everybody needs savings. That's how the capitalist system works, to protect for a rainy day, retirement, or to purchase some consumer good in the future. Just keep accumulating gold. And when you're doing it over a long period of time, you're ultimately averaging in at what will be an attractive price by the time this bull market is over. And it just becomes then a question of following the discipline, riding that major trend, and follow the program until gold becomes overvalued. And my sense is we're nowhere near that. We're still way undervalued, so we're still a long way to go before gold tops out.
Well, I think we have a very long way to go. But more importantly than that, I think when this ends, I suspect that gold will be reintegrated into the system in some way. And you won't have to sell it. You'll basically, at that point, it'll be a stable value and you can trade it in for other productive assets.
Yeah.
But until such time as that occurs, I think your advice is perfect, for the simple reason that the price action is counterintuitive a lot of the time. And if you just keep buying, particularly the periods of weakness, I would even go one step further and I would sort of step up my buying in periods of obvious weakness. And when it starts to get up there and the open interest is blowing out and it might be vulnerable in a trading sense, you might sort of, that month not buy as much. And that way you'll even get a better long-term price.
Yeah, it's interesting because we're in a period of obvious weakness, but gold is still $100 higher than it was a year ago.
Well, I know.
Which is what bull markets are all about,
and
I guess.
It's been fantastic the way the mainstream media and the people who've been influencing the market have affected psychology. And I mean, the one thing, the longer I live, the more I realize that people are so overwhelmed by psychology that a falling price engenders selling rather than engenders buying, which it should. You should be buying the weakness if you understand the fundamentals and this thing is inexpensive. Mm-hmm. But that's not the way the market works. I mean, price is going down, get me out. Yeah. They just don't understand the fundamentals.
We're seeing now in Europe bank runs. It's obvious in Greece. In fact, if you look at some of the statistics in Greece, it's very much like the Great Depression in the United States in the 1930s. In the 1930s, the Dow Jones Industrial lost 90% of its value. The Greek stock market is down 90%. The unemployment rate in Greece is about 25%, which is very similar to what it was in the States during the Great Depression. And then the money supply in the United States during the Great Depression dropped about a third, and the Greek money supply, because of flight of money out of the system, has dropped about a third. So I mean, Greece is in a Great Depression of its own sort. And this looks like it could be spreading to other countries now. Is this likely to propel the gold price higher?
Without question. I mean, I think that's the greatest fears of the powers that be, the contagion from the Greek situation. And the Greeks is only, what, 11 million people?
Yeah.
And I mean, if their bond market, they've already taken a good hit on the bonds. The only one people that didn't take the hit were the ECB. But if it spreads, and it will, because if you look at Spain closely, I mean, it's just a bigger Greece in many ways, which is sad, but their finances have deteriorated alarmingly. Mm. Well, that would have a much greater impact. And then with Hollande being elected in France, and his sort of idea that, you know, he's made promises to the public that austerity is not on the table. There's just a lot of things going on in the periphery of Europe, which to me suggests that the only way it can be contained is with greater money creation, and this is wildly bullish for gold down the road.
Yeah,
if not immediately.
You made an interesting comment before about gold coming back into the system, and it's something that I believe. You know, when this cycle in gold is finally over, you're not going to sell your gold; you're going to spend it. Mm-hmm. Meaning that gold is going to return as a form of currency. It's going to return to its rightful and traditional role at the center of global commerce. But it's only going to do that with governments kicking and screaming because they don't want to give up the power of being able to create money out of thin air.
Well, you're absolutely right. This will not be voluntary, but what will happen, in my opinion, is the fiat currency system that we've currently had, pure fiat system since we've had since 1971 when Nixon closed the gold window, I believe is on its last legs. And the public will not accept, after they see what happens to their money and their bonds and everything, they won't accept money that doesn't have some backing like it has many times in history. And I think obviously part of that backing will be gold. So to me, it's inevitable that it will be put back into the system. I don't think we'll have a pure gold standard again, but I do believe currency will be back. Maybe it's a basket of commodities, maybe it's gold and something else, but I do believe that before this is all over, that's the route we'll go. So I don't worry about having to sell gold this time like you did at the end of the bull market in the 70s, because there's no way that a Volcker is going to come along and raise interest rates, because the economy and the financial system would collapse.
Yeah, along with many of the banks.
Absolutely. The banking system would be absolutely devastated. And another issue that it doesn't get wide publicity, but it should, and it just came to the surface with this most recent JP Morgan fiasco, is derivatives. Yeah. And I mean, the derivatives have just permeated the entire banking system. And they're not being accounted for correctly. I mean, profits are being taken, but the losses are being buried on the books with phony valuations and what have you. And so consequently, I think the banking system is actually in worse shape than is being acknowledged.
Yeah, given the size of the derivatives.
Well, you're talking a quadrillion, really. They've sort of, Bank of International Settlements changed the definition, the way they define it, and said it's only 700 trillion. But these numbers are preposterous. Yeah. Because, I mean, they're 10, 15, 20 times world GDP. That's just sitting on top of an over-leveraged banking system. Yeah,
and like we saw in 2008, all you needed is one bank to go under or one insurance company to go under. That was a major player in the derivatives market, and you end up with big holes in the balance sheets of a lot of other companies.
Well, that's what bothers me about the JP Morgan sort of revelation. I mean, $2 billion, which was the initial hit, is in some ways a rounding error to JP Morgan, considering the size of their book, the size of their profits, etc. Why did they choose to come public with this and have their CEO, Diamond, just castigated by everyone for this? So to me, this may be just the tip of an iceberg. It troubles me.
Is today like 2008 when we saw a financial collapse? A number of big houses were brought to their knees?
I think the conditions may actually be worse, but they now they can go to school in the experience and what happened in 2008. So my suspicion is they will throw caution to the wind, and they will make sure that there's liquidity provided and no significant player will be allowed to fail. But if that is in fact comes to pass, again, wildly bullish for hard assets, because the value of the money in which they're denominated is going to be systematically crushed.
Yeah, but at the end of the day, there's a lot of bad debt out there, and that debt during a bust either gets repaid or it gets written off. So somebody's got to deal with that bad debt.
Well, you see, that's an interesting point, James, because if I were emperor and I was faced to deal with this, believe it or not, I would follow von Mises' advice, and I would take the collapse right now. I would start getting the debt out of the system, because hyperinflation just makes the problem worse, and it makes the ultimate crash even worse. Mm-hmm. But the sad fact is, somebody says, what would you do? And I'd say, well, I don't think I would have let myself get in this position. I would have taken the recessions 20 years ago and gone through a cleansing period from a much lower level. But by just having force-fed the system for many, many years, and then superimpose this massive quantity of derivatives on top of it, they've created a monster that they can't tame. And there's a great saying that I've always believed in, generally men can control the events, but at some points in history, the events become so massive and monumental that the men can't control them. I believe in a financial sense we're there.
Yeah, the event controls man,
Absolutely.
Rather the other way around, and man is unable to respond to it or to come up with solutions other than basics, of which, of course, at the end of the day comes back to gold.
Well, there's no
again.
solutions that are, basically it's just putting off the inevitable, which in my way of thinking just makes the inevitable worse.
Yeah. Well,
but, that's where we are.
The solution is getting rid of the debt, though, right? Somebody's got to take that loss for all the bad debts that are out there.
Well, that's why it's an interesting debate really going on in Europe today, because if you listen to the people that crafted the whole system, they want the creditors to be paid, and they're going to try to take that on the backs of the people that the countries took on excessive debt and what have you. But the people won't take it. There will be revolution. So I think in the end, sure, the debtor did a bad thing by taking on more debt than he could handle. But basically, the creditor should have done the due diligence and figured, I can't lend these people money. They're not going to pay me back. So I think in this instance, the pain has to be spread over everybody.
Yeah. When Lehman collapsed back in 2008, that was clearly a liquidity event. And people sold what they could sell if they needed to raise liquidity rather than what they wanted to sell. And all asset classes pretty much across the board got hit, including gold. And my view has been that there were going to be more Lehman events in the future, but that when the next one came, it wasn't going to be a liquidity event because everybody learned the lessons from Lehman that they wanted to stay liquid so they weren't in a bad situation. But when the event came, it was going to be more or less a fear event. And the distinction between a liquidity event and a fear event is that with a fear event, you may already be liquid, but you want to be certain that your liquidity is safe, and therefore you move to gold. So my view had been that in a fear event, the price of gold would rise. But here we are. The last few weeks, the gold price has been hit. It looks like a liquidity event again rather than a fear event.
Well, I think the fear event's inevitable. I think basically they're trying to mask the fact that they're creating enough liquidity to keep things stuck together. And as part of this, I call it a Ponzi scheme, a scam, whatever you want to call it, gold can't be seen to look good because that would be the canary in the coal mine screaming, get out.
Yeah.
And so consequently, as they have several times in this cycle, they take gold down. And but to me, it's just a passing event. And as you correctly said earlier, gold's still up $100 when we had last chatted, and yet it feels to the average person that it's in a complete bear market, and it's not. It's in a robust bull market that's just going probably at the end of another tough correction.
Yeah, you do get tough corrections in all bull markets. That's
Absolutely.
Inevitable.
Because I've always enjoyed Richard Russell, and as he puts it, basically, a bull market wants as few people going along with it. So it's constantly trying to trick you and get you to sell what you should be buying.
Yeah, yesterday gold was up beyond the 1% algorithmic limit that had been sticking at or keeping it below that level, so many times in the past. Is that a sign that maybe we are moving into a fear event?
Well, I think conceivably, there's so many things that could go wrong. And the last 2 days now, I mean, there's been a robust move in the gold price, way beyond more
and the shares.
And the shares, beyond the parameters that they had sort of basically contained it in sort of in the post Labor Day. I call the post Labor Day, the last 8.5 months, a pretty difficult period for gold and silver. And the fact that it's starting to rally robustly here is, you know, a positive sign. But I, quite frankly, won't be totally comfortable till gold has like $100 or $150 up day, because that's when I will be convinced that they basically aren't continuing to interfere in the market.
That's when the event is too big for man to control.
The event takes over, and fear, as you say, basically is rampant, and people just say, get me out of this paper, and I want something that's a long-term, stable source of value.
Yeah, and that will come someday, but nobody can predict the future.
I think it's going to come sooner than most people think. I mean, basically, this takedown has been so violent and the sentiment's so poor and the market's so clean that if we get something that would trigger a fear event, like something really awful going wrong in the economic or financial scene, and there's so many potential triggers, that I think it could set it off very quickly.
Yeah, I made the point just a couple of minutes ago about yesterday, gold was up big, but the shares were up big, even though the stock market itself tanked. I like to see that kind of a divergence, because if the shares were overvalued, the mining shares I'm speaking about here, if the mining shares were overvalued, they probably would have been tanking along with the general stock market. But it sort of stuck out as a sore thumb. When everything across the board was down, the mining shares were up. So is that maybe a sign that that's the bottom?
That was a remarkable day, and as you correctly point out, I mean, the great worry has always been if the stock market gets hammered, gold stocks will be seen as stocks. But the gold stocks have had their own private bear market for the last while. I mean, the Huey looked like it was breaking up, the unhedged gold index looked like it was breaking out a few months ago at 551. And then all of a sudden, the thing just cratered, and it broke down and traded comfortably under 400. And that's a big correction. And because what was going on in the day-to-day gold price didn't warrant that sort of activity. So I think the gold shares have had their bear market, and if we get a fear event that really starts knocking the general stock market around, I think that will be seen as bullish for gold, and it will tow the gold stocks up with it.
Yeah, okay, very good. Any last thoughts you'd like to share with these viewers? The last video that we did was extremely popular and understandable, because everybody really likes to hear what you're saying and thinking. Is there any parting comments that you'd like to share with the viewers? And this is going to be seen by tens of thousands of people around the world. Well,
I don't like to sound like a broken record, but the fact is that this is an insoluble problem in the world economy and financial system. And the end game is going to be very difficult. And as a result, you want probably the safest store of value you can have. And I think, without question, and from a historical context, and in today's valuation context, gold and silver are where you want to be. And if you want, they're the safest. And if you want leverage in that space, the stocks are remarkably cheap.
Yeah. John Embry, Chief Investment Strategist for Sprott Asset Management, thank you very much.
James, it's always a pleasure to chat, and I hope we can do it again soon.
Look forward to it. Thank you.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our gold research section.
Just didn't make a whole lot of sense. You could say it might have been overbought a bit because it had gone up sharply. But for it to be down like $350 over the next 3 or 4 months, to me just seemed like overkill. And then it was recovering nicely in February. And then we had what they called the leap day slaughter. And it was 1780 at that point. And suddenly they drove it down as low as 1525. And in the wake of terrible news coming out of Europe, and just a generally very positive backdrop in a normal circumstance for gold, and yet the price acted terribly. And I mean, I can give you a number of reasons why, and it had nothing to do with sort of logical selling. There was a lot of forced, selling.
Yeah.
And this created some natural selling, but just most recently, I noticed that when the gold price was getting really slammed around in the last couple of weeks, open interest was going up. So this wasn't sort of specs being driven from the market. There was lots of fresh shorting.
Europe is falling apart, and the banking systems pretty much everywhere are very, very fragile.
It's absolutely true what you just said, James. What I find perhaps most irritating is this expression, risk on, risk off. And so somehow they've gotten the gold lumped in with what are viewed as the risky assets, stocks, commodities, what have you. And that when there are problems afoot, like things are deteriorating alarmingly in Europe, they basically sell down all the risk-on assets, and they include gold, and they try to sell you the idea that basically the risk-off asset is the US dollar and US treasuries. And I mean, if you really stop and think about that very long, I mean, those in the fullness of time are going to be about some of the riskiest assets in the world, and anybody fleeing to them for safety, I think, is making a terrible mistake. What little you gain in the short run, I mean, it's a trade conceivably, but somebody's got to own all this stuff before this is over. And I mean, who wants
there? And the gold price goes down, so that I suppose gets people worried to a certain extent.
Well, that to me was so blatantly obvious. The LTRO of, as you say, 500 million euros, and within hours,
500 billion, I should say.
Yeah,
I said million, but
500 billion.
500 billion.
But within hours after that, Bernanke comes out and says some arcane statement about there was no QE planned in the near term. And this was the cover they used to slam the gold price down. I mean, the mainstream press has clearly been very negative, but I mean, if you actually analyze what they're saying, they're not saying anything. Perhaps one of the worst things I saw was one of the noted pundits on the subject said, because gold has been down so much in this environment, it's clearly not a safe haven. Well, that's why it is down, because they don't want it to be seen as a safe haven.
Yeah. But the point is that it's always a safe haven because it's a tangible asset. And it doesn't have counterparty risk, which is increasingly important as the banking system here in Europe.
And to me, the situation got horribly oversold. And we've started to rally the last couple of days. And I mean, we could sort of test the bottom again. But as I like to say, if you're negative on gold, you must be bullish on currency. And I don't see how anybody can make that argument. So consequently, we may have a few, $50, $100 in downside in gold under probably worse circumstance. You're probably talking thousands of dollars on the upside. So the risk reward is so positive that I'm not sure why people are upset, but they are. The sentiment is really about as negative as it gets.
Yeah, well, I think there's been a lot of negative news. The media attention that's been given to gold has been sort of negative, and that makes people worry, makes them a little bit scared. And plus, I suppose as well, to a certain extent, the New Year's, the leap year day slaughter, sort of counterintuitive because the ECB creates 500 million euros out of thin air. I'm James Turk. It's my pleasure to be here today with John Embry, the Chief Investment Strategist of Sprott Asset Management in Toronto, Canada. John, we're here in the island of New Jersey, in the Channel Islands. We were here a year ago. A lot's happened over the past year, but I wanted to ask you, when we were sitting here a year ago, gold was $14.90. Today, gold is $15.90. Silver is a few bucks lower than it was a year ago. Why all the panic in the market?
Well, I think it's the volatility that's being created, much of which appears extremely counterintuitive. I mean, the gold price peaked back at the end of August, $1,900, give or take. And this was in the wake of the US downgrade. And subsequent, like the attack on gold and even more so on silver,